Hatem Dhiab from Gerber Kawasaki joining me now. Great to see you as always. Hatem, what are we seeing in terms of demand still for the Mag 7?
Hey Juliet, good to be on. Every quarter we're looking at the Max 7 and wondering like are these companies not growing anymore? Is there some issues? I think what we're seeing is a decoupling, right? Like you can't really put all the Max 7s in the same bucket anymore because they all have seen different issues or different growth rates. Like for example, Microsoft is performing really, really well with over 33% growth both in its cloud and in various services. And other companies like Tesla, for example, who's not growing and facing some challenges because of brand issues. So I think that the reality is big tech is doing well, but at different paces and different scales. And you have to look at each company differently.
Indeed. Well, let's drill down into a couple of them then, especially when you're looking at, say, regulatory scrutiny. What does that mean for some companies, for example, Apple?
Oh, yeah, that's a big one, right? So there's a big antitrust trial here that's happening for Apple, and that's around the $20 billion a year roughly that Google pays Apple to be on the main search engine in the Safari on the iPhone and Apple devices. And that's a really big problem because it's a big revenue for Apple with basically 100% margin, and it drives about 50% of Google's iOS traffic. So I think that's something that's probably going to be challenged on the grounds of antitrust, and it would be a huge loss for Apple, also a huge loss for Google. But the reality is, I think AI is really disrupting that relationship anyway, and it's just going to force Google to really start pushing their AI initiatives, and same with Apple.
We know here in Australia that companies do very well on the market the day they announce a share buyback or increase a share buyback. What's going on with share buybacks in the US amongst the big tech companies? Specifically, I know Netflix.
Yeah, Netflix is one of the stocks that actually is doing really, really well. And it's actually trading at really high valuations now. And I wish it was part of the Max 7. But they've been executing on such an amazing thing with growth around the world, being able to really open new markets and get into new things like sports and really executing overall. But yeah, they've started a share buyback because they just have so much free cash flow, and they're really able to, and they reduce their overall expenses, so they're really able to give some of their cash back to shareholders. Usually that's a good thing. You don't see a lot of tech companies do it, although Apple has been a big buyer of their own shares. I would argue that a lot of these tech companies are quite expensive relatively, so I think share buybacks don't make a ton of sense, especially in a time where you need to invest a lot of money in AI and infrastructure. So I think you'll see that happening in the future.
All right, let's talk more broadly then about what we're seeing with the overall impact on the US economy. The Moody's downgrade I was just talking about with Vishnu, perhaps not that surprising given it was the last agency to downgrade. But what does it mean more broadly for the health of the US economy, Hatem?
Yeah, it was interesting that actually the market was not down today, even though we got downgraded. I think it's really a testament to the what's going on with uncertainty around, especially the fiscal situation that the U.S. government is in right now. You know, we have a $2 trillion a year deficit, and our debt to GDP is almost $30 trillion, and it's growing. So I think what Fitch is saying is that this is not a sustainable base to be on. And then frankly, there is a tax bill that's making its way through Congress right now, and it's actually, instead of making things better, they're actually increasing the deficit. So I think what Moody is saying, and Fitch as well, is that hey, listen, you really need to figure out your fiscal situation because you have almost $10 trillion in debt that needs to be refinanced this year. And if you don't bring down your deficit, your cost of refinancing that debt is going to go higher. And that's what you're seeing right now, right? You're seeing the 30-year or the long end of the curve hit 5%, which also meant that the mortgage rates were at 7%. So that's a huge, huge hit to the U.S. economy and the consumer. And frankly, we just need rates to come down. So that's kind of what we're seeing right now.
Yep, and of course, as you've got all of those headwinds that we're mentioning, your point earlier was that you sort of have to look forward and what's going to be the driver of revenue for companies, and I guess it continues on this AI thematic.
Yeah, I mean, it's funny. This week is the 25-year-old anniversary of the tech bubble that burst in the 2000s, right? And it was a bubble, right? There's nothing like that happening right now, right? These are real revenues being spent on real infrastructure for real efficiency gains, right? That's what we're seeing. And if you start to look through the revenues or earnings for companies, you're starting to see that actually companies are using AI and really improving their margins as a result. And you're starting to see also all these deals across the world to build that infrastructure, because everyone knows this is really the next frontier. So I think that theme is just starting to play out. And that's why actually, after the market selling off almost 20%, you've seen things rally quite a bit, because people understand that these are great businesses and will continue to grow.